Welcome to class SS2 Economics students. Is your economics teacher Mr. Labi. In today's lesson, we are going to be treating the topic public finance. And running through our objective for today's lesson, you should be able to define public finance. You should be able to state the objectives of public finance. You should be able to we are going to look at taxation. You should be able to define taxation. You should be able to explain the principles of taxation. You should be able to explain the types of taxes. You should be able to state the advantages and disadvantages of the types of taxes, and you should be able to classify taxes. Let's go straight to the day's lesson. Public finance. Public finance is an aspect of economics that deals with government income, expenditures, and debt operations, and the effect of these activities of the government on the economy. Again, public finance is an aspect of economics that deals with the revenue, that is income, the government expenditure and debt operations, and the effect of these activities on the economy. What are the objectives of public finance? The objectives of every government is to manage the economic resources of the country and to ensure economic development and well-being of the society. So these are the major objectives of public finance. Number one, generation of revenue. In public finance, government generate revenues to cater for the welfare of people. Two, improvement of balance of payment. Now, the aim of every government is to ensure a favorable balance of payment. So, the objective of public finance is a favorable balance of payments. Number three, equitable distribution of income. Another important function of public finance is to ensure that the income distribution is equitable and to close the gap between the rich and the poor. The fourth one is to create employment to ensure that level of unemployment is reduced to the barest minimum. Then the last one is price stabilization in order to curb inflation and deflation and ensure that price marginality is very minimal. Let's go straight to taxation. I'm sure you've heard of this word before, tax and taxation. Now, a tax is a compulsory levy that is imposed on income of an individual, um, profit of a company, and also on goods and services. So, taxation is the act of government imposing compulsory levy or duties on income of individuals, profit of companies, and on goods and services. What are the principles of an effective tax system? One, equity. Now, equity means that each individual should be made to pay according to his ability. That is, you should be able to you should be made to pay tax according to the amount of income that you earn or the amount of profit that you get. Two, economy. Economy means that the process of collecting tax must be cheap and easy to collect. That is, the revenue that is obtained must be more and in excess of the cost of acquiring the taxes. Three, convenience. Convenience means that the means of payment of taxes must be convenient for the taxpayers in terms of the method of payment, the form, and the time of payment. So, for example, most income earners do what is called payee, that is, pay as you earn. Payee. Now, this method makes it convenient for people to pay their taxes immediately as they are receiving their income. Their tax deductions are being made. Next one is certainty. Certainty means that the amount of tax to be collected must be known by everyone concerned. That is, I already know the tax that I pay as an individual, so it must be certain. Taxes that are paid by individuals, companies, corporations, and on goods and services must be certain. Then next one is revenue yield. Revenue yield means that the revenue that governments obtain from taxes must be stable and predictable over a period of time. Now, this stability and predictability helps government to be able to plan on the income or revenue that they get over time, especially in terms of carrying out capital expenditures. Then the next one is neutrality. That is, the tax collection must be neutral. It must not have an adverse effect on the economy. That is, high taxes must not affect the well-being of the economy, and it must not deter economic progress of the country. Then benefit received. Benefit received, that's the seventh one, explains that the beneficiaries of government revenue or government spendings must pay tax for whatever they receive. That is, Benefit received means that people that enjoy the benefits of government expenditure must be made to pay tax for whatever they benefit. That is, people that do not enjoy a particular government expenditure or government project should not be made to pay tax for it. For example, people that enjoy free water from the government should be able to pay tax on the water. People that enjoy government goods or government services like bridges, roads, and so on, they are the ones that should be made to pay taxes, not people that do not enjoy it. Flexibility. Flexibility means that a good tax system must be susceptible or must be capable of being changed over time. Then the last one is simplicity. It must not be difficult to administer and calculate. Then types of taxes. We have two types of tax system. You have the direct tax and you have the indirect tax. The direct tax refers to taxes that are imposed or duties that are imposed on individuals' income or on profit of companies. Under indirect taxes, we have different types. Under direct taxes, we have different types of direct taxes. Remember, I said we have two types of taxes, direct and indirect. Direct taxes refers to taxes that are imposed on income of an individual or on the profit of companies. Then types of direct taxes. Number one, you have personal income taxes, that is taxes that are imposed on an individual's income. Two, company tax, that is taxes that are imposed on a company's profit. Three, capital tax, that is taxes that are imposed on capital assets or assets of an individual or assets of a company. For example, taxes that are imposed on an aeroplane, a mansion, a building, an estate, and so on. Then you have poll tax. Now, poll tax refers to taxes that are imposed on individuals on a flat rate. That is, when individuals pay equal amount of taxes, irrespective of your income earned. Then the last one is expenditure tax. That is, taxes that are imposed on capital expenditure engaged by an individual. What are the advantages of a direct tax? Number one, it is progressive in nature. That is, it makes um, uh, higher income earners to pay more. Then it does not cause inflation. It reduces income inequality and it is convenient to taxpayers. What are the disadvantages? One, it is prone to tax evasion. Uh, people can decide not to pay this tax. So most people evade these taxes. It discourages investment because people believe that the more I earn, the more I will be taxed. Then lastly, it is difficult to assess. It is difficult for proper assessment, especially companies that declare false profit. Indirect taxes. These are taxes that are imposed on goods and services. Types of indirect taxes: custom duties and tariffs, that is import duties, export duties, and excise duties. Then you have sales tax, taxes that are imposed on the sale of goods. Then purchases tax, I think we mentioned purchases tax, just like expenditure tax, taxes that are imposed on the expenditure incurred on commodities, large commodities like televisions, cars, so on. Then you have value added tax. Value added tax are taxes that are imposed on goods at various levels of production. When taxes are imposed on goods based on the level of production at which it is, then we are talking about VAT. Classifications of taxes. We have two basic classifications of indirect taxes. You have the ad valorem tax and specific tax. Ad valorem tax are taxes that are imposed per unit. They are imposed on per unit percentage of quality of goods. That is, on each unit of goods, based on the quality, taxes are imposed. For example, on a car, based on the quality,